Coming up in today's episode, the media continues to tell us stocks are heading higher. Call option activity in mega cap growth stocks hits the highest level since 2021. The Eurozone slips into a recession. More economic woes out of China. Corporate earnings expected to have their third quarterly decline. The US starts to refill its strategic petroleum reserve. The SP500 and NASDAQ find new highs for the year. And Tesla shares continue to rip higher. Welcome back to Click Capital, everybody. I hope you're having a great Friday. And it was a pretty flat day here out to finish the week. Did see some good moves in a select number of the mega cap techs with Tesla, Netflix, Salesforce, Adobe, and AMD all putting in a good performance. But the rest of the market was pretty flat, especially utilities, energy, and a few of the REITs and industrials came off as well. And since it's the end of the week, here's a look at the 1 week performance on this heat map. We can see that mega cap tech did come off, except for Tesla, which had a huge week up 14%. And good breadth in the energy, utilities, industrials, and financial sector this week. No economic data out today, but next week will be the big one. We got CPI out on Tuesday, and we're expecting the core inflation rate year over year change to be 5.3%. And this is the last big data point the market and the Fed will be looking at before the Fed comes out on Wednesday with their decision. And so we could expect a bit of movement in the market based on that CPI number. If these two numbers here come in a lot higher than expected, the stock market should have a pretty good sell-off. However, if they come in a bit softer, we may get another rally up in the stock market as the Fed is highly likely to pause, which the market will love. As it stands today, the Fed Fund futures market is given about a 30% chance that the Fed does hike on Wednesday. And of course, that number will change a lot after we get the CPI numbers 7:30 a.m. Eastern Time Tuesday morning. So currently the Fed is likely to pause. However, the market's still given a higher chance that they're going to hike again in July. However, that's not stopping the media from constantly telling us we're in a new bull market and stocks are heading higher, and that bearish investors will have to start buying, helping to push the market up even more. And the case the bulls are making is that the recession fears are overblown. Is not to worry about it. Just look at the price action. Think about AI, and investors should expect more gains ahead. And it's not hard to find AI stock picks. They're all over the place. And analysts are telling us that the chip stocks can keep rising. And so all this price action in mega cap tech and the media piling on along with Wall Street analysts is what's propelling call option activity in mega cap growth and tech stocks to the highest level since 2021. And as much as I would love a new bull market as well, because making money in a bull market is a lot easier, I just can't ignore all the contrasting data out there. And there is quite a bit, which I'll show you in a second. For starters, the Eurozone is already into a slight recession here, as they just revised numbers in Germany and Ireland. The governments do a great job at coming out with numbers, then a few months later saying, oops, we got it wrong. And so the technical definition of a recession is when we see GDP decline for 2 consecutive quarters. And since they just revised the Q1 figures down, that puts the Eurozone into a technical recession. So you could basically split the world into 4 major economic centers. You got North America, the Eurozone, China, and Japan. And so the world's second largest economy, China, is showing more signs of trouble as well, with their factory deflation steepening as demand is coming off a lot for their products. Now, some of that's got to do with the West deleveraging from China, but also it's just a sign of a slowdown in global growth. And if the Chinese government numbers saying they're slowing down, you can be pretty sure they're slowing down by at least what they're saying. And things are starting to look so bad there that a lot of young people in China are flocking to the temple to start praying for some luck, with some visits up 530% in March and early April from a year ago. And that's because China's jobless rate for young people has gone to a record high of 20%. Even JP Morgan says stocks could drop 20% if bonds have inflation right, and no chart illustrates that point better than the Move VIX spread. And that shows the difference between bond market volatility and equity market volatility. And we're currently as elevated as we have been since prior to the global financial crisis in mid-late 2008. And so typically bond market traders are more sophisticated than equity market traders, and they tend to price upcoming events a lot better. And so the bond market is pricing in a lot of upcoming economic uncertainty and volatility, whilst on the other hand, equity market volatility is pricing in the best of best times ahead, with the VIX at a very low 13.8 here. And we can see that in the equity put call ratio as well, with a 5-day moving average at 0.78. So those record call options, people are just piling into mega cap tech, betting that it's just going to go higher and higher and higher. However, one of the biggest structural drivers of the equity bull market over the last decade or so, especially since COVID, has been quantitative easing by central banks, and that's them basically creating fake money to buy up all sorts of assets and securities, and thus flooding the system with liquidity and giving a strong backstop in the markets that traders can lean against. However, that's all reversed course now, and central banks around the world have flipped the switch from quantitative easing over to quantitative tightening, where they're looking to reduce their balance sheets, stop purchases, and let assets mature and offload them off their balance sheets. And that trend's already started across the world, and we can see that in this yellow line here, which represents global central bank liquidity in the system, and that has been declining, and we're currently at the largest gap between what that model says should be fair value in the S&P 500 at 3782 and where we are today, finishing at 4300. So again, I'm not a perma bear. I was net long for most of the bull market. And like I said before, I would love another bull market. It's super easy. You can pretty much throw a dart at the board and make money. However, it's just hard to ignore all this data. And jumping in with the crowd and the media and Wall Street analysts kind of goes against my instincts as well. And the guy who pretty much invented the yield curve recession indicator, Campbell Harvey, says the Fed's done enough economic damage regardless of its next move, and a self-inflicting recession is on the way anyway. And even though the Fed has done its most aggressive and steep interest rate hike in history, we've still got inflation at double their target rate. And now Harvey sees the chance of a hard landing for the US economy. And don't forget corporate earnings, which play a huge role in stock market valuation and sentiment, are already in a recession. We've had 2 straight quarterly declines in earnings per share from the S&P 500. And FactSet expect the third quarterly decline in earnings of 6.4%. Last quarter was 4.8, and I think the quarter before that was 6.7. And this is with an unemployment rate at 3.7%. So most people still have a job, and we've already got corporate earnings in a recession. You can just imagine what happens if unemployment rate ticks up above 4 or 5%. And so the forward PE ratio as it stands now on the S&P 500 is 18.5, which is just a little bit above the 10-year average of 17.3. However, you can't look at stock market valuations in a vacuum. You've got to look at them relative to the risk-free rate from government bond yields. And so as it stands right now, there is hardly any premium in equity market earning yields versus, say, the 2-year government bond yield, which is around 4.6% at the moment. And so if earnings contract further, then that'll push the forward PE ratio up even higher. And the Fed isn't done hiking yet, so the government bond yields are increasing. And if we see corporate earnings continue to decline, the spread between equity market premium and bond yields will continue to grow in the favor of bonds. Another storm cloud out there is commercial real estate. And again, we've got another billionaire today, Jeff Green, sounding an alarm on it, and he actually made almost $1 billion back in 2007, 2008, betting against the real estate, and he's saying offices are going to be hit hard if a recession strikes. And he goes on to say, we are heading into a very frightening time in the entire real estate industry. He goes on to say, look what's happening in the office space today, and this is before the slowdown. Wait until we have the recession. Another news out today, the US has started to refill its strategic petroleum reserve. They paid $73 a barrel, and we've been knowing they're going to do this for a while now, and that's why I kind of think that crude is supported here in the high 60s. However, we do have declining global growth as a headwind against that, with the Eurozone in recession and China demand coming off, so we may come down and test these mid 60s again. However, that should just be more of a chance for the Biden administration to refill the oil reserves, and plus OPEC want oil back at 80, so if we get back down to the mid 60s, you can expect OPEC to cut production again. But once again, the stock market is ignoring all that bad news and continues to party like it's 1999, with the fear and greed index ticking up again to 77 here. Busy day in the options market as is usual for a Friday, with a lot of contracts expiring. 45 million contracts traded and another huge 59% calls. Same old story, all the call options in the mega cap tech. And once again, this unusual put option activity in the high yield corporate bond ETF. Dark pool buys showing up today, with the DIX increasing to 52%, and corporate insiders continue to sell more stock than they're buying at a ratio of greater than 2 to 1. And here's a chart of that explosive growth in SPX call option volumes, and a lot of that's got to do with the 0 days to expiry with the new daily options. A lot of people betting on what's going to happen in the next 24 hours with the options. Okay, back into the charts. We got the S&P 500 actually found 43.22 today, but did a little bit of a shooting star inverted hammer pattern on weaker volume here. The Qs as well, pretty soft volume for a Friday, a little bit of a spinning doji at the top of the range. Here's a look at the weekly chart of the Dow Jones Industrial coming up to this resistance zone. Quite a bit of mess here in this sideways market. There's a look at the weekly chart of the Russell 2000. We had a good couple of weeks as they've done a bit of a catch up, but we've got a bit of overhead resistance here. And we can see that in the daily chart. We pulled back again a little bit here. International stock indices for the whole continue to trade weak and well under their 50 days. Here's Canada's TSX, the UK FTSE, German DAX holding up a little bit better. Japanese Nikkei has been on a tear ever since we got news out a month or so ago that Buffett had invested a bunch more into their market, and the Aussie and the China continue to trade weak. And here's a look at the weekly chart of the world's second largest economy stock market, the China 50 index. And we can see ever since that peaked out in Feb 2021 at over 20,000, it's come off almost 50%, now down at 12,500. And so the Chinese stock market is still well and truly in a bear market. Here's another look at the VIX index, super low here. Really steep percentage contango in the term structure of the volatility market. We've still got the VIX 6 month at 19.5 and up front at the 9-day 13.2. So 30 at 13.8 is very low. And next week we got CPI, the Fed, and regular monthly options expiry on the Friday. So one could expect the VIX to tick up next week, especially if that CPI comes in higher than expected. That should set off fireworks in the market and a large repricing, as the market is expecting the Fed to pause. And that's probably what's helped the stock market hold up pretty well these last couple of weeks. Got breadth just stalling out a little bit here, 70% of stocks above the 20-day average, and the amount of stocks making new highs has come back down significantly as well. Over the spread charts, the growth versus defensive sectors actually ticked up slightly to a new high year to date. And there's a spread between small caps and large caps just pulling back a bit after we had that nice bounce up earlier in the week and Friday last week. So I'll be looking for the 50-day to hold on this and for small caps to continue outperforming after they've been beaten down here for a few months. Commodities still struggling versus stocks finding new lows for the year. And there's a look at the yield curve, the 10-year yield minus the 2-year yield, creeping back down into deep inverted territory. And remember, the inverted yield curve has always predicted a recession. And the average time we get a recession after the bond yield goes inverted is typically around 9 months or so. And so we're a bit past that average time now. Sometimes it can take up to a year or a little bit longer. And just remember, looking back through history, the stock market is always bottomed after the recession has started. And that's the big one for me. That's the one I just can't ignore and get my portfolio so net long like the media, Wall Street analysts, and all the call option buyers are doing as well. It's not easy going against the crowd. However, I'm not trying to hit it out of the park with returns. I'm also trying to protect what I've got as well. There's a price action in the government bond 2-year yield holding pretty firm here. Same with the 10-year, holding up pretty good. And same with Fed Fund futures. There's the June contract, and that 0.12 is that 30% probability that they'll hike on Wednesday. And there's the September contract, and that 0.29 is saying there's a much better chance that they're going to have hiked by September, and December's still a little lower at 5.10. So as it stands at the moment, the Fed Fund futures market is saying they're going to pause on Wednesday, probably going to get a hike on July, then they'll most likely pause for a couple of months and maybe cut by Christmas, as the bond market's predicting that we will go into a recession later this year. And there's TLT holding up just under 102. Quick look at the monthly chart on TLT. And if anything bad, unexpected happens in the market, we could expect a jump in this as we get a flight to safety. And if the Fed only does have one more hike left in the bag, then this 100 level should prove as support. Because remember, bond prices and yields are inverted. So as the Fed has hiked rates, that brings the value of existing bonds down, as investors can buy new bonds with higher rates. And so that's what caused the largest pullback in TLT. Since it IPO'd over 20 years ago, it's come off more than 48% before we've had a little bounce here. And if the Fed does start cutting rates, then we can expect the TLT to climb. So in a typical portfolio of long equity and risk assets, a small to moderate allocation to TLT can make sense and is a good hedge against a recession and any other unknown bad news coming into the market. On top of that, it pays an almost 3% dividend yield. And here's a look at the high yield bond ETF. We can see that's continued to track sideways and a real sluggish price action here. You can see on our range strength at 17.4 is a huge reading, which means there's just no trend in this market. And this is the counterpart of equities. So normally high yield bonds have a bit of a correlation to the equity market, as they're the riskiest area of the bond market. And you can see back here on Feb 2, when we had that swing high in the stock market, high yield bonds got up there as well, and we're nowhere near that as well. So that's a big divergence between the high yield bonds and the equity market. Dollar as well. Typically a strong dollar is negative for equities. However, the equity market has completely ignored this bounce up of support over the last month in the dollar. And there's Bitcoin just calling up as we go into the weekend. And even with that stronger dollar, which is typically negative for commodities, commodities have been hanging in there, holding this support zone. Over to stock sectors, there's the AI ETF bots, still really elevated at the top of the range. Semis ticking up a little bit, but still consolidating. Bit of a pullback in retail stocks. Energy stocks still trading sideways. Regional banks having a little bit of a pullback. And pretty flat overall here today. Not many big moves to report on. And look at Tesla rip again. Here we open at $2.49 a share, went above $2.52. Super technically stretched here. This is on the news that GM is partnering with Tesla, so GM drivers can use the Tesla supercharger network. And this was after we got news from Ford that did a similar partnership a couple of weeks ago. And so not only is Tesla 5 to 10 years ahead of their competition in terms of infrastructure and technology to build electric vehicles and operating margins, already selling them for a profit, when GM and Ford doesn't think they can do it until the 2030s. Now Tesla is going to be providing the infrastructure for the industry as a whole, so you can expect more partnerships with other car brands that want to latch on to Tesla's huge supercharger network and technology. It's better for them to actually bite the bullet and go with their competitor than try and build it out themselves. And so the markets absolutely loved that and marked the price up of Tesla huge here. However, technically speaking, in the short term, we're setting up for an island reversal, and that's where we've gapped up here. We've finished lower than where we opened, and if we gap down Monday and come off, then that sets up for an island formation. And we're super extended up here. We can see the entire candle above our buy-sell band and wave flow indicators. And just taking you out to a weekly chart here, we've had 4 green candles. And just looking at that 250 level is a spot and psychological price where the market has turned before. So in the short term, we can expect a pullback. However, in the medium term, this is positive price action for Tesla. We're clearly in an uptrend now. And with the Cybertruck due out later this year, that's a really good reason for the market to get super excited with that. So long as the NASDAQ is holding up and hasn't crashed, then we could expect Tesla to pull back and maybe even come up to 300 later this year. There's a chart of NVDA, climbed up a little bit here today. Didn't quite get to 400 a share. However, I wouldn't be surprised if we go into 400 a share next week and test that high of 420 we made 3 days after earnings. And I'll be looking at the price action around that level if we get there to see if we reject off it. Or who knows, we may get another huge green candle all the way through it. Same with Apple. So we put in this bearish engulfing candle on Monday after they released their new VR headset. Looks like we may be coming up to test that high again. And for this to confirm as a reversal pattern, we need that to reject off there, then come back under and close down here. Similar pattern in Microsoft. We had that reversal candle here on volume. Just done a little bit of a low volume pullback here, and we'll be looking for some lower closes on volume to really prove that this is a reversal formation. Similar story on Amazon. We had that big down day on Wednesday on volume. Then we've done a couple of inside days here as volatility and volume coils up, and the market's kind of undecided, waiting to see what its next move is going to do. Same again in Google and Meta, and the exception Netflix, which actually found new year-to-date highs today. And it's been performing well ever since their crackdown on password sharing, and the new ad-supported tier is performing well for them. So once again, Netflix proves the critics wrong there. Here's a look at the Coinbase chart. Those of you watching the channel know I got short at $62 a share last week. We look to have tagged and rejected off the 50-day here. And just looking at our stock fair value indicator, we've got fair value at 35. And since an input into this indicator is future earnings expectations from analysts, I'd expect the valuation to deteriorate even further in coming weeks, since a lot of customers would have pulled out their deposits and activity in business with Coinbase after the news that the SEC is suing them and accusing them of operating an illegal exchange. That to me is not bullish for the stock, so I'm going to continue to hold this one short. There's a look at Carvana. You know, I covered this yesterday on a huge short squeeze, and I told you yesterday this is probably going to fall over and come off hard. Even though there was a risk that the squeeze could keep going, it's kind of as close to gambling as you can get, and we came off 21% today and falling more and after hours as well. This crowd favorite C3 AI still holding up here at 37 a share. Active today was DocuSign, which we got earnings out, and they did a pretty good beat of 29%. We gapped off, but the market just completely took advantage of it and sold it off hard into the close. And there's a look at the price charts of General Motors and Ford, loving that news that they're going to partner with Tesla. And since the world is moving into electric vehicles, you can think of these other brands now as just kind of jumping on the back of Tesla along for the ride. And so in my mind, the battle has already been won in electric vehicle space by Tesla, and it's hard to see anyone knocking them off that leadership for many more years, especially considering their brand strength among consumers and their already existing profitable operating margins. Here's another look at one of my shorts, Royal Caribbean Cruises. Actually put in some positive price action here today on higher highs, higher lows on volume. So I do expect this to come up into the mid 90s, high 90s. into that resistance zone I've got here on the weekly chart, and I'll probably add to my short position around that 95, 96 levels again. Going to hold this one for as long as we can because we get a global recession. This thing should come off hard as its valuation and balance sheet is already really risky. Target stock got slammed again today, down 3.2% and testing those lows we saw a week ago. And a bit of a pullback in the most vulnerable regional banks, but they're still well above their 50-day VWAPs. Same with Charles Schwab. And here's a look at our new SP 500 oscillator, continuing to show the market is overbought here with a reading of 61.49 to finish out the week. And again, I believe it's highly likely we're at or near a short-term top in the market, especially the NASDAQ as well, which is really elevated. And we've been stalling out for a week here. And just remember all that price action I showed you in the mega cap text. We've got these reversal candles hanging in there. We just need some confirmation on them. But typically before price moves, you'll see it stall out at that level and come up and retest, put in some reversal candles. Then all of a sudden, out of nowhere, we can get that big down day on volume and a bit of a rug pull, and all those call option buyers will wonder what's happened to their premium. And so that's the way I'm continuing to stay positioned, 60% net short in the portfolio, staying diversified and keeping balance between longs and shorts, and just following the data and the indicators instead of the hype and the media. And so next week should be an interesting one with the CPI on Tuesday, Fed decision on Wednesday. The market's expecting them to pause. If CPI comes in weaker, we might get another little rally in the market. If it comes in a lot higher, you could expect the market to sell off. And then that's going into a busy options expiry on Friday. All starting from a very low VIX level. So next week will be interesting. And that's all I've got for you this week. Thanks very much for tuning in every day and hitting that like button. I really do appreciate it. Hope you have a great weekend. See you again Monday afternoon.